Five passive income stocks. Microsoft, the company that didn't only completely recover from the recent stocks market crash, but it hit the record high. With a valuation of the $1.5 trillion, it seems like it will be one first companies to cover $2 trillion valuations. But how much your money would worth if you have invested just $1,000 in Microsoft IPO? As the 2018, your $1,000 would have turned to $1.6 million. And in the last 2 years, the stock price more than doubled, so you would have earned much more than that. When you think about passive incomes, you probably imagine the real estates and that type of the income. But the stock market isn't just about the price of the stocks, but also the way to earn passive incomes. When you buy a stock, so you are literally becoming an owner of that company. The stock isn't going to give that much influence over the company, but nevertheless, the company is obligated to share with you some of its profits, and that is called the dividends. Some companies pay a lot of the dividends, others are not that much. In the case of Microsoft, it's $2.4 per share, or a little over $1 per 1% of if that doesn't seem like a lot of the money. Let me tell you that some companies don't pay anything like Amazon or Facebook. Over many decades, Microsoft has proved itself to be one of the best investments ever. Its revenue has been increasing consistently every year with $125 billion just last year. It is sitting on the cash pile of $136 billion with no signs of slowing down. The company is founded based on the innovations. Despite the success of the Macs, it still slightly dominates the computers market, with Windows being almost not every computer. It even began producing it hardware in recent years. If you know anything about Amazon, you know that the backbone of its success is Amazon Web Services, where Amazon provides on-demand cloud computing platform, and it's controlling one third of the market. But do you know who is second biggest player in this market? Yeah, you guessed it right. It's Microsoft. Although divided yield it's high at Microsoft, it is still there, and the company is growing at an unpredictable on percentage speed. It won't surprise if it hits the $2 trillion valuation in the next 2 to 3 years. So if you want the super safe investments that's growing tremendously and pays constant dividends, you should be looking at the Microsoft. Second on our list is Johnson Johnson. You are definitely familiar with this company. In fact, it's one of the oldest companies out there. It's a huge medical business with multiple companies under its wings. It products on the shelves of every country all around the world. The stock price hasn't been growing as some of the tech companies out there, but in the kind of the dividends. For over 57 years in a row now, it has been increasing its dividends and has been one of the safest investments you could make. Annually, they pay dividends $4 per stocks, which is a dividend yearly 2.75%. That's more than that some of the largest corporations pay. I know that some of you aren't impressed because that barely beats inflation. However, you have to consider that the safer the investments, the lower the returns are. It's also working on the creating the vaccines for the current pandemic. If it is success, its stock price might soar as well. In the case of in the case of Johnson Johnson, historically speaking, for the 6 decades, it hasn't just been paying dividends, but keep increasing them. So, if you are the warning on the investments long term, Johnson and Johnson might be one of the safest passive income stocks. The third on our list is also Tech Company. It's a company that manufactures your favorite smartphones. Yes, I am talking about Apple. This company doesn't need any introductions. You probably know a lot about it, but let's take a look at its dividends yield. Currently, it's a little lower than 1% or $3.28 per stocks as of the May 2020. Don't be scared by the fact that has such a low dividends yield. The problem is that the stock's price has been increased so fast that you have to take a look at the context. For the last decades, Apple had a 2% yield. Sometimes it was higher, other times it was lower, but it was around 2%. And the company in such great shape that even after losing around 30% of its value due to the pandemic, it's back and is hitting the new record high. Since the invention of the iPhone, the company's revenue keep increasing year after year, even though the smartphone industry has stopped growing in recent years since it has reached its limits. The company still managed to keep its revenue at $260 billion last year. The company is focused now on taking over the budget phones sector with the introduction of the iPhone SE. Of course, $400 is still expensive, but Apple holds a brand name that people about the world value and are ready to pay the extra. Even if it's budget phone, the pandemic illustrated to us that it's one of the safest companies in the world and nothing would stop it from growing. Even though it might be paying the dividends of the just 2%, you can be confident that on the other side the stock's price is also increasing, making you wealthier. The next on our list is Wovi, an American retail company specializing in the home improvements. The company operates a chain of the retail stores in the United States and Canada. As the November 2018, Wowi and its related businesses operated 2,000 homes improvements and hardware stores in North America. It's the second largest chain in the US, founded in the 1921. It has been growing since then. If you take a look at the stock's price, you realize that it has 5 years, so the stock's price has doubled. Although it suffered tremendously due to the pandemic, so like the companies we mentioned previously, it recovered quickly. It was one of the companies that suffered the most by losing half of its value overnight. Currently, its dividends yield is 1.68% or $2.2 per share, which is not bad for such stable and safe investments. Various companies might not seem to have the high rates of return. However, you have to consider the fact that first of all, they are safe compared to the rest of the market, but more importantly, their stocks is also growing. For instance, Wowi stocks is the at least 12 months increased by the 30%. It was also playing paying dividends, so you are benefiting from the rise of the stocks and also having a passive income flowing into your account. On the top of that, you are confident that your investments aren't going to anywhere since it's a strong company, and the current pandemic is the proof. And finally, the Home Depot, the largest home improvement retailer in the United States, supplying tools, constructions, products, and services. It operates many big box format stores across the United States and its territories of the Guam and the US Virgin Islands, all the provinces of the Canada, and the 31 states of the federal districts of the Mexico. And compared to rival Wowi, it pays a higher dividends of the $6 or 2.3% in the last 5 years. The stock price has increased from the $110 to $254, went right in the script. With strong inflation, financial statements, and $110 billion in the revenue last year, the company is looking forward to taking advantage of the digital world. The company has been investing in the digital channels with the One Home Depot initiated the announce in the December 2017. The dividends of these five companies might not seem impressive, but when we are talking about the passive incomes, you want something safe, something you don't have to look after every single day. There are many companies that provide much higher dividends yield, but the stock price can crash overnight, and those high dividends won't make up for the losses of the stock price. That's why this list is made up for the safest companies in the market that pay some dividends and are grown over time. When you buy the stocks, it doesn't bring you any tangible value. You just hold it and wait for someone else to offer you a higher price for it. And when you make the sale, the only your profit or lose. However, I want to point that just because one company pays the dividends doesn't make it a better investment than the other companies. If the companies would not pay dividends and reinvest that cash back into the company to grow faster, maybe that is the better options. Amazon is the perfect example of that. Until today, the company hasn't paid a dime in dividends. Even after three stock splits, the Amazon stock price is $2,600. Investors clearly made a much bigger return of the stock price than if they would have received the dividends.